Welcome to the Property Code, your ultimate guide to mastering strategic real estate investing. I'm your host, Nick. Before we dive into the crucial IRS rules, I want to share a personal story that highlights the power of real estate when approached strategically. A few years ago, I made a pivotal decision to invest in a modest duplex. I was living in one of the units while renting out the other. It wasn't the most glamorous setup, but as I stood on the porch one chilly morning sipping my coffee, something profound hit me. The rent my tenant was paying was actually covering a significant portion of my mortgage. That moment was a revelation. I realized that real estate wasn't just about owning property, it was about building long-term wealth, creating an asset that could work for me. But there was a challenge. While the property was cash flowing, I couldn't fully leverage the rental losses due to passive activity rules. This limitation was holding me back from scaling my portfolio as quickly as I wanted. That's when I discovered the real estate professional REP designation. By meeting certain IRS criteria, I could qualify for REP status, which would allow me to treat my rental losses as active rather than passive. This was the key to unlocking new capital and accelerating my growth. With a few simple strategies, I could turn those trapped losses into powerful financial tools. I'll break down how you can do the same in just a moment. The real estate professional designation is more than just a status, it's a game changer. When you qualify as a real estate professional, your rental activities are treated as active for tax purposes. This allows you to use real estate losses to offset other sources of income, like wages or business income. Normally, rental losses are considered passive, meaning you can only use them to offset passive income, such as from other rental properties. But as a real estate professional, you're not subject to these limitations, which opens up the door for greater financial flexibility and quicker portfolio growth. To qualify as a real estate professional, there are 3 key criteria you must meet according to the IRS. 1. 50% test. More than half of the personal services you perform across all your trades or businesses must be in real property activities. In other words, your primary focus throughout the year must be real estate related. 2. 750-hour test. You need to log a minimum of 750 hours of real property service in a given tax year. These hours must be directly related to the management or operation of real estate activities. 3. Material participation. For each rental activity you claim, you must meet one of the 7 IRS material participation tests to ensure the activity is treated as non-passive. This is where your hands-on involvement truly matters. Here's your action plan to follow these criteria and successfully qualify as a real estate professional. Step 1. Activity mapping. Start by listing every real estate business you're involved in, whether it's brokerage, property management, renovations, leasing, or acquisitions. This will give you a clear picture of where your efforts are focused. This is your business roadmap, and it will serve as the foundation for your qualification process. Step 2. Time tracking. Next, implement a robust time tracking system. Tools like Toggle, Harvest, or even your CRM's built-in timer can help you record every minute you spend on property-related tasks. Whether you're showing homes, negotiating contracts, handling tenant concerns, or conducting repairs, every task counts towards meeting your required hours. Logging every minute ensures you're not missing any opportunities to qualify. Step 3. Build an audit-ready ledger. Your time logs need to be organized and verifiable. Set up a digital ledger with precise date and time stamps for each recorded activity. For even more clarity, integrate this log with your CRM, so every lead, lease renewal, or repair ticket automatically captures your participation hours. This keeps everything transparent and ready for any audit. Step 4. Block real estate days. Schedule consistent, dedicated blocks of time each week for real estate tasks. Treat these days as your non-negotiable work hours. For example, you might set aside Mondays, Wednesdays, and Fridays for property showings, client meetings, and paperwork. This scheduling helps you stay disciplined and ensures that you're maximizing your time for the business. Step 5. Quarterly audits. At the end of each quarter, run a compliance audit to check your progress. Compare your logged hours with the 750-hour requirement and verify that more than half of your total service hours are devoted to real estate. This helps you stay on track and identify any areas where you might need to catch up. Step 6. File your election. Finally, when it's time to file your taxes, attach an election statement to declare your real estate professional status under Section 469(c)(7) of the IRS Code. This should be included with Form 8582 or your original tax return. Pitfalls to avoid. Spousal hours. While your spouse can help with material participation, their hours won't count towards the 50% or 750-hour tests. Be sure to track your hours separately. Commingling activities. You cannot mix non-rental real estate activities or passive partnership hours with your rental property activities. Keep each activity distinct and ensure that only qualifying activities count toward your REP status. IRS scrutiny. The IRS carefully reviews REP elections. Keep your documentation organized and ready to verify every hour worked. Use work orders, emails, and calendar entries to substantiate your time logs. How to know you're on track. As you monitor your progress, keep an eye on these key metrics. You've logged over 800 hours of hands-on real estate activity. Over 55% of your total hours are spent on property-related tasks. Your ledger is complete, accurate, and audit-ready. You fully utilized your allowable rental losses, accelerating your capital and cash flow. These aren't just numbers, they're proof that you're effectively leveraging your time and maximizing your potential as a real estate professional. Strategic accelerator moves. Aggregation election. Combine multiple properties into one activity for simplicity and faster compliance. Joint venture design. When partnering with others, structure your deals so that you can allocate participation hours efficiently and maximize the tax benefits. AI automation. Use property management tools with AI capabilities to automate tasks like rent collection, maintenance scheduling, and tenant screening. This will free up your time to focus on higher-value strategic activities and ensure your qualification as a real estate professional. Remember that moment on the duplex porch? That's the power you can harness when you qualify as a real estate professional. You shift from being a passive investor to an active wealth architect, using strategic tax rules to fuel your portfolio's growth. Thank you for listening to The Property Code. Subscribe, leave a review, and share this episode with your network. Until next time, stay disciplined, data-driven, and always strategic in scaling your real estate empire.